Welcome to the December edition of AML Voices. I'm today's moderator, Elliot Berman with AML RightSource, and today we're going to talk about the patterns and trends in AML compliance programs. I have an excellent expert panel with me today to discuss some of what you should be thinking about as you head into 2025. With me today is Jenny Halloran, Deputy BSA Officer and Head of Financial Crimes Investigations at First Citizens Bank. Rachel Byrne, the Senior Manager of AML and Sanctions Governance and Programs at PNC, and Terry Pesci, President and CEO at Terry Pesci and Co. And we have a list of things that we want to talk about, and we're going to start. And Rachel, I'd like to start with you about lessons from enforcement actions. So not specific lessons, but how do you use enforcement actions and what you're reading in there in your program?
Yeah, absolutely. And thanks for having me today. Excited to get into these topics, and I'm glad we're starting with enforcement actions. In preparing for today's conversation, we have a team here at PNC that tracks and reviews and dissects and analyzes all the enforcement actions that come out. I'm sure a lot of banks have a similar team than that. And when I asked them to kind of pull kind of the numbers for this year, since I know there was just an enforcement action yesterday, so I guess we're not done yet. But my feeling is that we had a lot more enforcement actions or penalties this year than we did last year. So they pulled the numbers, and I was right. My vibes were right on that one. So per our internal tracking, we've had twice as many enforcement actions that we reviewed this year compared to 2023. So it's not just in my imagination. It's been a very, very active year for enforcement actions. There were obviously a couple pretty high profile ones that were issued in the latter half of this year that I know we've spent a lot of time analyzing, dissecting, since they were banks that were similar sizes to my current institution. And I think it's important to know that, every enforcement action is obviously born out of very specific and unique circumstances. So I don't think we need to delve into them specifically, as you mentioned, but there are still broad themes that I think that have emerged that we're tracking that I think are universally applicable, regardless of the institution size, that I wanted to kind of start the conversation off today by kind of delving into. So I'll talk about a couple of the ones that we were kind of monitoring from my institution. The first one, the first theme is just this idea, this failure to fix problems or address risk after identification. And I'm in a governance role in my current institution, so I spent a lot of my days telling people that governance is not here to ruin your lives, to make your lives more difficult. It is here to protect the program. And we've all heard this before: if you didn't document it, it didn't happen. However, documentation is not the end of governance, and I think these actions really shine a light on what bad governance looks like. And effective governance, at the end of the day, it's not just an exercise in paperwork and making sure you're identifying the problems and writing them down or collecting the information. So I think the actions this year, they cited a lot of examples of institutions going through the motions, right? They're identifying the risks, they're identifying issues, they're collecting the required customer data, they're generating detailed risk metrics, and they're documenting that all as part of their program governance routines. These are obviously all great things to do, but that was the end of it, right? And whether that was because of lack of resources, lack of will, poor compliance culture, inefficient processes or controls, these institutions then sat on these risks, these issues, these data, and that's not an effective program, right, at the end of the day. So you can't just identify an issue, you have to fix it. And I know that sounds obvious, but one of the actions I think cited, there was, I think, over 90 issues that were tagged to an institution's CDD KYC processes, which is a lot of issues. And they sat there on the books for years and years, and they weren't able to fix them. So you need a robust issues management process in order to drive accountability. Similarly, you can't just report metrics every month and not perform any kind of analysis on it or do anything with those metrics. One of the other actions cited a very specific example, I think, of an institution producing reporting on, high dollar cash or deposits at certain branches where the most ETRs are being filed, what customers are filing the most ETRs on, reporting that out, I think, on a periodic basis, either every month or every quarter. but not doing anything about it, just kind of reporting it as part of facts of their organization. And they were criticized for that. And similarly, you can't just collect customer data on transactional activity expectations, put it in your systems, and not perform any kind of monitoring against those expectations. So that's the first thing I wanted to highlight. I think the second one is kind of broader, and I think it's important for all of us to take a look at our governance structures. Because ineffective governance structures, unclear roles and responsibilities, that was another key theme that I think emerged. A few of the actions cited examples of siloed governance structures where the AML officer did not have appropriate oversight or authority over certain areas of the program due to how the program is organized. And so I know I've worked at a few different institutions in my career to date, and every organization, I think, sets up, they're structured in a different way. I think a lot of these structures work. I think at the end of the day, the regulators are agnostic in how you set up your program. But I think it's important that however you decide to do that, that your structure still clearly designates ownership and accountability of your core program activities. So there needs to be transparency and roles and responsibilities, so you know who's responsible for what, that you have documentation that defines what those are, and also defines the channels in which your AML officer is informed of any risks or issues. And so one thing that I think comes to mind that I think we'll see more of, and we saw, not to talk about a specific enforcement action, but the one yesterday, I think is fraud, which I think we're going to see kind of more of next year. So fraud obviously is a function that a lot of organizations choose to sit in the first line, and I think that might make sense. A lot of the times that's how we do it at PNC. However, at the end of the day, your AML officer is ultimately accountable, right, for all SAR filings. So you need to make sure that any fraud activity, if it's being investigated in the first line, make sure that you have oversight over it in the second line, that it's being done consistently, that the fraud SARs are being filed consistently as your AML SARs, as well as being ingested back into your AML processes, so your customer risk scoring, account closing processes, that sort of thing. Make sure that that's all coming together. And then I think the last one that I've noticed just throughout all of them, I think one of the clear themes is that the board of directors needs to do more. And we all know that compliance, the culture of compliance, that starts at the top. I think the tone at the top. We know how important that is, and that the board needs to understand the risks and receive enough information to provide oversight of the program. And I know at the institutions I've been at, that's been a common debate in terms of how much information does the board need? How much information does the board want sometimes? Because you don't want to overload them, right? But you need to give them enough so they can sufficiently perform oversight. And I know one action mandated, the board to perform credible challenge of the annual risk assessment process. So that's pretty specific, and I know that might be above and beyond what you're currently doing at your institution. So I think it's a good idea to take a look at what kind of information you're giving the board. Make sure it's sufficient. So I think that's a good exercise for all of us to do. So I'll stop there. Those are kind of the key ones that we're kind of monitoring right now, though.
Jenny, anything different at your institution?
I mean, I think Rachel just gave an excellent summary. I think we're doing a lot of the same things in terms of tracking the actions and kind of trying to tie them back to the controls that we have to ensure that we're sufficiently covered. I think one of the things that folks can do with these enforcement actions is utilize them in their conversations with first line of defense business leaders. I think folks who haven't spent their entire career in BSA don't necessarily understand that it is not prescribed through very clear regulation, that the BSA itself is very simple and vague. And so sometimes you'll get stuck in a conversation with somebody who will say, well, what does the regulation say? And it's hard for them to understand that that's not the answer. There's a lot more to it in terms of regulators' expectations of how we apply the regulation. And I think that enforcement actions are an opportunity for us to communicate in terms with business leads in a language that they can understand. So instead of getting caught in that back and forth about the regulation, you can say, here's a recent enforcement action. And if you have a case that you have within your own institution that kind of harkens to something that was written in an enforcement action or a scenario that you feel like is somewhat similar, being able to, share that scenario or that case with somebody in the first line of defense, and then show them in the enforcement action, what transpired with another institution who maybe didn't take a different path or apply a heightened control to that risk. I think resonates with them in a way that I've not been able to see with any other, method of communication. And so I just always try to encourage folks, utilize these to help communicate what we need to be doing and why we need to be doing it, especially with folks who aren't just living and breathing BSA, because it really is a way that I think speaks to them at a different level.
Terry, are you seeing any of your clients do anything significantly different than Rachel and Jenny are talking about?
No, and I think both made very good points. With Jenny's point in particular, I think it is important in particular to educate both board and senior management on enforcement actions, because sometimes it comes down to resources and not just whether or not the body is willing, but whether or not the body has the ability to actually effectuate what needs to be done to not find yourself at the wrong end of an enforcement action. And I think it's particularly necessary if your regulators have not found a vulnerability that you may have in a past exam, because I countless times I've helped banks out that are under scrutiny, that have MRAs or something, where they said, well, I don't understand it because in the last 5 years we had absolutely no findings and everything was fine, and why is there this problem now? And the truth is the ball moves, and I think the enforcement actions are a good way to educate others on how that ball in fact does move. And I think also one of the points that Rachel made as well with respect to the board needing to do more, that's the board is definitely, highlighted in a lot of not just the regulatory enforcement actions, but the law enforcement actions too, the DOJ enforcement actions. And so there truly is vulnerability and potential liability on the part of the board as well as the bank.
So, Terry, that's a great segue, your comment about the ball moving, to the next topic that we talked about in prep for this, and that is the kind of general feedback that institutions often receive during an exam from an examiner may not make it into the report, but it still makes it into someone's notes and maybe becomes some kind of an unofficial expectation. And Jenny, talk to us about that a little bit.
Yeah. I think that some of the things that I've been seeing in recent years that have evolved from, where my career first began, is that we're seeing regulators become more organized in terms of the way that they are examining banks and creating kind of specialized groups of examiners who maybe are really adept at a particular banking risk or product or demographic. And having those folks come in and conduct a targeted examination on something specific that your bank is doing. And I actually really like this model because I think for a long time, our examiners would come in for the BSA AML exam and it would just be like anything and everything was fair game. It felt like, our BSA officers were having to speak to every control that a bank should have. And what I'm seeing is that with this kind of evolved approach, of course, we still have the annual BSA AML exams, but we're also seeing additional exams that I think are assessing specific risks across the board. And so what they're really looking for is like, what is your overall risk management framework? What is your first line of defense doing to manage these risks? What is your second line of defense doing to manage these risks? How are they communicating and coordinating to make sure that you are staying up to speed on how those risks are evolving, right? Because we can launch a product, we can create some kind of banking relationship that at the beginning, at the outset, we have a certain amount of controls that we think are really strong. But then as time goes on, just like Terry's mentioning, the ball is always moving. And not only do we need to be on top of that and figuring out where we need to pivot, strengthen controls, change controls, but we need to be making sure that we have all of that clearly documented and communicated. And Rachel and Terry also talked about too, making sure that your board is part of that process, that they are aware of all of these things. that they understand what we're doing to continue to manage the risks appropriately, and that your team as a whole across your three lines of defense are united, I think, in your approach. So that's been new for us, I would say. I think that there's also a focus on fraud and your fraud risk management framework. Sarah Beth Felix had an excellent post yesterday on LinkedIn. If you don't follow her, I would recommend that you do, with just some key takeaways from the USAA consent order. And it was talking a lot about fraud, internal and external fraud, and the controls that you need to have in place there, that it's really, sometimes people think, oh, as long as we have people filing SARs on these things, we're good, but that there's so much more to it. And she makes a recommendation to always be thinking like a criminal in terms of your products and services and how a criminal could exploit them. And in my, experience, that has always been a supremely effective way to get in front of things and make sure that you're aware of what's happening and figuring out what you need to do to mitigate the risk. And then finally, I'd say that it's just kind of back to basics too. All of the cornerstones of our industry are still front and center in the conversations. What is the quality and timeliness of the operational work that you are producing? And those things will never leave us. We spent a lot of time talking about machine learning and AI and behavioral analytics, and all of those things are important. But at the end of the day, a lot of it just boils down to, do you have effective processes, and do you have well-trained people performing this work? And that, in my opinion, that will never go away.
Terry, thoughts?
One of the things that was really interesting that Jenny said was think like a criminal. And having been a former prosecutor, you often have to think like a criminal to try and figure out what the criminal is doing. But I think that's a very valid point, which raises don't just talk to regulators about what's going on and what's the ball is moving. If you have communication with law enforcement, I think that's really important, because law enforcement will also tell you about the trends and the things that they're seeing, and they really appreciate understanding what you're seeing as well. So relationship with law enforcement, I think, really can help you understand what those trends are going forward, and what you should be thinking about as you move forward with your program and for transaction monitoring, for example. What are you looking at? What are your scenarios monitoring for? What should you be looking for in your investigations? That relationship can really help with that.
Rachel?
Yeah, I agree with everything that my fellow panelists said. I would add to the one question or ask I'm seeing more of in the target exam and the roll-up exam, our monthly meetings, with our regulators, is they want to see more documentation around our strategy. So in terms of not just like a list of strategic priorities that we have, or projects that we're working on, or initiatives, they want us to see it all, put it all together, and to have that feed into how we're deciding our resource allocation, and all of that. So making sure that we're thinking through all of that. So they're asking to see more and more documentation. There's an expectation that, that we're doing that, and anticipating future changes to typologies. The AMLA, I know we've gotten some proposed rulemaking, but we've got questions already of, are you thinking about this? Show us how you're thinking about this. How are you planning on plugging this into your program? So I think I'm seeing the examiners expect more of us to be more forward thinking, I think, than I've seen, I think, in the past.
The one thing that I would add, and Jenny, you mentioned it, that you need to be aligned across all three lines, but I think having a really good relationship and ongoing conversation with internal audit is really important, because they come at the world a little differently, and that's a good thing, because it's a very important fresh set of eyes. But keeping them in the loop as new ideas are being tested, new things are being put into the program, as opposed to just when they come to do an independent review. And different organizations do that on a different cadence. In smaller institutions, it really is a once a year, 3-4 weeks of focused look, and then you get a report, and you move on until next year. In larger institutions, I expect, just because of the size, many of them are doing it in a much more semi-continuous way, if you will. But keep, my view with the auditors was always no surprises. They shouldn't say, well, how come you're doing this? That means we failed because we didn't talk to them and let them know what we were doing. And while they're not supposed to be responsible in any way for the operational side of the program, there are times when they will give you a really interesting insight about something you're thinking about putting in terms of how in the world am I going to audit that? So you put it in, now how do I prove up that it's working? And, getting that conversation in the development stage can be really valuable, so that you get a good independent view. Because I think the other things regulators have routinely done is they're following the work papers, not exclusively, but they're definitely inputting the independent review work papers into their review when they come and do an exam. So I'd urge everybody to do that. So we've talked a lot about risks, and we've mentioned the fact that, Jenny, your insights into the fact that we're seeing regulatory exams that are more focused on specific risks or products or the like. Terry, what are you seeing in the risk assessment area?
Yeah, we talk about relying on work papers. The regulators will rely on your risk assessment too if it's worth anything. So it's worthwhile to have a good one, because otherwise the regulators are going to come in and do their own. And that's not really new. Risk assessments have been around for a while, and they've been cited in enforcement actions as not being adequate or not existing at all, despite the fact that they are still not required by law or regulation. Um, they are expected, and not only are they expected, but to go back to something that I remember Rachel or Jenny said about documentation. I mean, risk assessments now need to be both quantitative and qualitative, but the quantitative part in particular needs to be documented. The sources of documentation need to be clear. The depth and the to ensure the completeness of the data that you're using needs to be clear. It's very critical that you have looked at not just what are my inherent risks from a quality side, but what are my inherent risks from a quantity side. So if I have 100 high risk clients based on their entity type, but they're only conducting 10 transactions each a year, well, that sort of brings my risk down, right? So those are the kinds of things that I think are expected from regulators. It's not just, this looks like high risk or this looks like low risk, but what's the quantitative component of it that makes it either higher or lower risk? So looking at usage, a product may be high risk, but if it's not being used frequently, or you've only got very few clients in it, that reduces the risk. So these are things that regulators are really looking for, that quantitative analysis that is incredibly well documented, both in terms of the source of the data that you're using and the analysis of the data that you have done. So the work papers for risk assessment, I think, are also critical, as they are for audit. Keeping in mind with respect to risk assessments, now there is the proposed rule that's out there that would make them mandatory. If that goes through, not only would it be mandatory, if it stays as is, there are a lot of interesting components at it, because you're not just supposed to be looking at your risks for money laundering, terrorist financing, and other financial crimes, but you're supposed to be analyzing your risks against FinCEN's priorities, which are very different from one another. I mean, how are you measuring your risk for human trafficking and drug trafficking and corruption and organized crime? And what does that look like if you're conducting a risk assessment that's analyzing each of these factors? We don't know if that's going to go through as is, but it's out there, and it would require not only mandatory risk assessment, but a much more detailed risk assessment. So things to be thinking about when you're moving forward. One other thing to note on risk assessment, and not just the sort of the inherent risk and the quantity of risk, but the quality of the controls. I've seen on a number of a number of times when regulators have said, "You've told me a control exists, but you haven't told me if it's working." And that's critical, is to show that you have actually assessed the effectiveness of the control, not just the existence of the control. I'll stop there. Um,
Yeah, that's an interesting, it's a question you hope you never get asked, I guess. Rachel?
well, yeah. But you will, because believe
Right.
I've seen it in multiple places. It's like, okay, you have the control, but is the control working? And what are you doing to assess it? And that's a very good question, because how are you assessing each control? Are you relying on your independent testing, or are you doing, a self-assessment? Is the business testing the control? It's an interesting question, and one that I think is not that easy to answer sometimes.
Yeah, I agree. Yeah, and to go back to the proposed rulemaking, because again, as you mentioned, it might not go through, but it is out there, and we've definitely been examined on things that haven't gone through before. So I think that I found interesting about the proposed rule was how it emphasized not only made the risk assessment mandatory, but also emphasized the centrality of the risk assessment to the program as a whole,
Right.
potentially, arguably elevating it right to be even a sixth pillar. And so I think right now the way we think about risk assessments, they take a lot of resources to perform. They're performed, and periodically we update them quarterly here at my current institution. But at the end of the day, they're primarily retroactive. They're documenting things that have already happened. So I think it's important to kind of take a look at your risk assessment process in preparation, either for that rule or just for kind of raised expectations from the examiners, to make sure that it is more of a proactive tool for identifying risk and for looking at things like resource allocation, making sure that that you're sharing those results with your first line partners and you're making them actionable, so they understand what to do with it. So it's not just a document that just sits on the shelf somewhere and until you update it the next quarter. So I think those are all important things to think about.
Yeah.
And I think it's important also and I think people do this, but it's important to keep those lines of communication open to different parts of the organization. So if you've got a product development group and they're working on a new credit card or a new whatever, um, who's ever responsible for the risk assessment needs to know about that, because those can't, launching or pre-launching new products can be a trigger for an update. If you don't have, some organizations do it just with uh, a periodic, we're going to do it every quarter, every, every half year or annually. But I think as the risk assessment continues to become more and more prominent, regardless of whether the regulation actually goes into effect. I mean, it's gone. Risk assessment's gone from a whispered idea to, a major issue without the regulation ever coming through over the last 20 years. Um, that curve isn't going to change if the regulation doesn't go into effect. So figuring out how to make sure that you're, particularly in larger organizations, where easy line of sight from the AML and compliance teams to the business teams is more difficult just because of scale. In smaller institutions, there there just aren't that many there aren't as many people, so you're talking to those people for other reasons pretty regularly. But in large organizations, I think it's an issue. We do have a comment about the whole issue of, is your control working? A back testing strategy on checks and controls would be very helpful. Um, good comment. The key is to make sure, going back to comments made, I think Rachel, you made them, about roles and responsibilities being clear. Where is that? Where is that plugged into your program? Is it only in the independent review? Is it in, it probably shouldn't only be there. It should be other places too, but someone's got to have that on there. That's yours list. And everybody needs to know that.
Elliot, just one more point, if I might, to follow on something
Sure.
Rachel said in particular, also with respect to, sort of the residual risk and using the risk assessment. The residual risk is another mechanism to train senior management and your board, like these are the things that are not covered. They need to see the risk assessment and they need to see what's not covered, and they need to understand that the examiners are going to come in and look at your residual risk and ask you what you're doing about it and what you're doing to try and close that gap.
Yeah, 100% agree. So another thing that we've seen, and in as a hot button item the last several years, and it certainly came out in some of the um, enforcement actions that we've seen in the last year or two, is third-party access to the bank. So banking as a service. I've said this to many people. I'm going to say it to the three of you and to our audience. Banking as a service is not new. 15, 20 years ago, we had a different name for it. It was called Rent-A-Charter. We decided to put a little, nicer gloss on it, and make it sound like a product line. But it's gotten some banks in trouble. There are some banks who do very well, operating it like a product line and understanding the risks. So, Rachel, give us some insight about where you feel all this is going and how people can do it better.
Yeah, definitely. I mean, the regulator, if you go to any conference, right, third party access, third party risk, they're hammering it at home. So they haven't been subtle that they see this as a continued challenge for banks. And as you mentioned, it's banking as a service is not new, right? And it's definitely a model and a partnership that I think has matured over recent years, but there's still obviously risks around it, right? And I know a lot of banks have formed these strategic partners with fintechs to great success, I think, in some cases, to offer a wider range of services, to reach more customers. There's clearly a need for that in the marketplace. So it's not necessarily a bad thing. I think you just have to make sure that you're addressing the risks before you go into this space. And so I think at the end of the day, I think you always need to remember that, as a bank, as a financial institution, you own the risk of your customers, including your customers' customers. So just confirming that your fintech partner has an AML program, it's not enough, right? And a lot of fintech programs or fintechs have AML programs now, and some of them are pretty mature programs. But just confirming, collecting evidence of that isn't enough. You have to be interrogating it kind of consistently, definitely before you start allowing them to transact through your institution, through using your products and services, and then throughout the relationship. I think you have to be very thoughtful about how you perform oversight and design a control framework before you enter into relationships with these types of customers to make sure you're doing your due diligence. What is the purpose of this partnership? What are you getting out of it? What are they getting out of it? Making sure that your kind of strategies are aligned there. Making sure that you understand their business model at the end of the day, how it works. Bringing your tech folks to make sure you understand how the technology works. Make sure you understand their customer base and the inherent risks around it. Before the activity starts, it's very, very important. And, the interagency guidance that came out last, I guess, 2 summers ago, really kind of, I think, hammer this home that you need to establish clear roles and responsibilities and document those roles and responsibilities so you know who's responsible for what. So bring your legal team in, make sure you have contracts and program agreements in place before this activity starts, and make sure that you're doing continuous monitoring of the transactions and activities, and that you have the right mechanisms in place to make sure you're fulfilling your SAR filing responsibilities. I think once you get this up and running, make sure that you have ongoing communication with your fintech partners who are using your products and services. You should be meeting with them on a very regular basis. Make sure that, especially in the beginning, I think it's a good idea to do some kind of testing, whether that's you bring an independent party in to do testing, do your own testing. Those are things that I think you really have to think of. And then, at the end of the day, make sure also, and this is something I've heard more recently from regulators, is make sure that you have some kind of, defined termination path in place in case the risk gets greater than what your institution is willing to accept. So make sure that that's built into the contracts and program agreements, because once you kind of open the services for this, sometimes it's harder to unwind that and get out. So make sure that that's all kind of part of your framework. So I think those are all things that you kind of have to think about before you get in. So you have to dedicate a lot of resources, I think, in order to do this right. Obviously, there's a lot of benefits to these kind of partnerships, but you have to make sure that you're balancing it with the right level of resources dedicated to it, and you have your control framework in place around it.
Jenny?
I'll offer a kind of practical and somewhat boring takeaway in regard to this topic, which is that one of the challenges that I've personally encountered in this space and in the examinations that are applied to it is that folks are using terms inconsistently, and folks seem to have different definitions for what banking as a service means. What does fintech mean? And so I think it's really, really important that you as an institution get really clear on what it is that you are doing, what you're not doing. And when you say that we're doing X, what exactly does that mean? And what does it not mean? We've had just so many, I think, ineffective conversations because there's a lack of streamlined definition around what these things mean. And like I said, super boring, but really important, because otherwise I think you can spin your wheels for a long time, miscommunicating both with your auditors and your regulators, but also internally. So making sure that across the bank, you guys have specific terms and that you're aligned on what that is, and that you can very clearly communicate to your regulators what it is that you're doing and what you're not doing, I think saves everybody a lot of time and wasted energy.
Terry. Nope. Terry, you're on mute.
Sorry, I was trying to save you all from my phone ringing in the background. The house phone that I can't control or mute. In any event, yes, and I still have one. I know I'm a dinosaur. No, I mean, I think that's absolutely true is, not only defining what they are, but, some of it is also understanding what your customer does. And it's incredibly critical to do like deep due diligence on these kinds of entities so you understand exactly what it is they're doing. And are they actually a third-party payment processor or a fintech, or are you providing banking as a service? You need to understand what your risk is before you can manage it. There are banks out there that will not accept, banking as a service clients, but they need to understand when somebody approaches them that that's what they're asking for before they turn them away. So that's incredibly important. And I think Rachel also touched on the contractual obligation or aspect of it. And you can have some control over the relationships with the contract to require them to have, an anti-money laundering program, to require them to be screening their clients against the OFAC list so that you don't inadvertently end up processing transactions for sanctioned parties, to put an audit right in there, so that you can come in and test. I think you mentioned that as well with respect to testing the firm's or the client's program. You can put all this in your contract, so that you have those rights. So the contractual agreement with these types of clients is really pretty important.
I agree with that. And this is one of the places where the lawyers, and I have done that kind of work for many years, not doing it anymore. And the operations people, the technology people, have to really get in a room and understand when you talk about unwinding these things, how do you really do it? And, we've seen in the last couple of years, a couple of really serious problems happening because you had a tech stack effectively of different providers. And I've never seen any of the contracts for those tech stacks in the failures, but the challenge is that when one party can't stand and deliver at the quality level that they presumably were required to do, it ripples through the entire relationship. And in the 20 years ago, many of what are now called banking as a service relationships were broker dealers that were not connected with a banking charter organization wanting to offer a checking account like product. But what you had on both sides of those arrangements was people who were pretty sophisticated in financial services and being regulated. And you didn't have, in most of those, unregulated organizations that were bringing the technology. one of the things that's complicated the current group of these arrangements is you've got a mix of folks. You've got folks who really know the technology, how to move the money from point A to point B, how to, do other parts of it. But not everybody has a comparable understanding of the regulatory expectation or even how everything happens end to end. And so I think there's a lot of contracts can help, but I think another thing is really having good preliminary meetings where everybody's in the room and that goes to your definitions issue, both internally and externally, Jenny, that you literally talk through it, and every time someone says something, whoever says it, and when I say X, I mean one, two, three. And if someone says, "Oh, no, that's not what we mean," okay, let's come up with a new term, but and it's very um, intensive work, resource intensive work. Not that it's bad, but it is resource intensive work. One of our audience members pointed out in the chat, I'm sorry, in the Q&A, that the Wolfsburg group this week actually published some information on payment transparency. And actually, John Byrne and I will be, for those of you who are listeners on This Week in AML, we talk about it in tomorrow's episode. But a good point. There are more guidance documents being put out. FATF is working to expand its recommendation 16, which was originally designed principally around wire transfers, to be more broadly about payments. And many of these relationships do have a payment provider component to them. So more to come. So Terry, another thing we talked about going into this in our prep was the idea that there's a certain amount of regulation by contract, for lack of a better description. Can you talk a little bit about that?
Yeah, I mean, I think that's kind of what I was talking about already, which is imposing an anti-money laundering obligation on an entity that doesn't have one. So third-party payment processors are not required to have an AML program, and registered investment advisors are still not required to have an AML program, even though it's been talked about over and over and over again.
Right.
But banks,
remember, there's no risk there, so it's okay.
Oh, right. Yeah. Okay. Nothing to see here. Just move along, right?
Yeah.
Well, same thing for third-party payment processors, and some of the other payment processors. But that's where banks can impose that obligation by contract on their clients, and say that if we will not bank you unless you have an anti-money laundering program with all the bells and whistles that are required. So I think some of what we talked about. Yeah.
Yeah. So I'd like to talk about another one. So there's a lot, and I don't want to. It's in the de-risking, debanking space. Not so much about a lot of the back and forth about whether it's good or whether it's bad or whether it's being used by some to in what I'll call inappropriate ways, but more about sort of so we assess the risk of a particular client. We determine that it's no longer within um, the bank's risk appetite, or at onboarding, it's outside the bank's risk appetite. So we're going to say no. But that's not the end of the story, because we've now made an internal business decision, but at the moment, there is no federal law in the United States requiring a financial institution to take any particular customer. Now, before those in the audience raise their hands and go, yeah, but I mean, there's anti-discrimination and all. Yes, that I understand. We know that's out there, but I'm talking about just on a risk basis. But Terry, there are state laws that come into play, and as banks have become much less creatures of one geography. I mean, when I got got into financial services, banks couldn't cross state lines, couldn't have offices beyond state lines. And there was some debate in some states whether they could have customers beyond state lines. That's all gone away in the last number of years. So, Terry, what about state laws that might restrict closing?
Yeah, there are a couple that are either pending or are already enacted, one in Florida and one in Tennessee in particular. And it's sort of it is about not de-risking, but not the type of de-risking we're used to hearing don't do. It's not about don't bank, please bank the unbanked, don't de-risk in that way. This is really very political. What they are saying is you cannot close an account for reasons that are, based on a person or entity's politics, religion, social media presence, industry that they are in. All of this is very much aimed at not closing. It's not closing ultra conservative accounts that may be potentially taking positions that are maybe not within, to your point, the bank's risk appetite. For example, um, if someone expressed political views that favored the activities of January 6th, that might signify to a bank that there is the potential for activity that may be risky and they may not want that account or they may want to close that account. You cannot do that under these laws. Any account that you close, you have to have a true risk-based basis for. The client whose account was closed has the ability to challenge your closure before a state body, and you have to defend yourself for closing the account. Otherwise, you're subjected to relatively severe fines. So it's worth looking at those two. Related, and while you said there are no federal laws, there is some federal rumbling out there. There was a report that came out a few days ago by the called Financial Surveillance in the United States, how the federal government weaponized the Bank Secrecy Act to spy on Americans. And it is an interim staff report of the Committee on the Judiciary and the Select Subcommittee on the Weaponization of the Federal Government. Yes, it's a mouthful, but that's what it is, of the U.S. House of Representatives. So this is coming out of the House. This is not coming out of a think tank or something. And there is real criticism about the use of the Bank Secrecy Act to collect information without warrants, which is what it has been all the time, because obviously we collect information on our clients and it gets filed in a SAR if there's something that we see that's suspicious. According to this group, filing of SARs is basically providing the government with information without the requisite probable cause. It's a very interesting perspective. It is along the lines of you must provide banking services. You cannot cut people off. Mentioned in here, I think, was it's either here or there was an op-ed that spoke to it in the Wall Street Journal a couple of days ago about closing the accounts of Melania and Barron Trump, and whether that was purely political, and whether the Bank Secrecy Act was being used to debank those people because of politics. It's an interesting movement. It'll be interesting to see if there are changes with the new administration in terms of Bank Secrecy Act enforcement, considering this wing of Congress and what their thoughts are. Anyway, long-winded way of saying maybe harder to close accounts than you think, even though your regulators are telling you close accounts for very risky people. So.
Yeah, years ago, there was a pretty serious debate about account closing, and one of the arguments made by the industry was, in addition to there not being specific laws at that time restricting it, is if you're telling us that we have to do business with everybody, then you're telling us we're a public utility, and then we need to be regulated differently. Now, I don't know that those arguments will resurface in the current environment, but there was a fair amount of discussion about that. And I've been at this way too long, so this goes back quite a ways. But But it is an interesting, in most cases, other than discrimination issues, businesses in many countries, but particularly in the United States, have had the freedom to choose who they do business with. Again, not there are certain protected classes and things like that, but just other than that, which is an important protection, but other than that, they don't have to do business with you. But if banks are told you have to do business with everybody, puts them in a very different situation. We'll see how it comes out. We've got a couple.
Just one point on that. In terms of like the Florida law, for example, but not being able to close based on industry, I think that's aimed, for example, at the firearms industry. And there are a lot of banks that have sort of prohibition lists that do not want to do business with any kind of firearms dealers or munitions dealers. So, what do you do with that?
I worked at a bank a number of years ago, and on our list was a smaller institution than either the one you're at, Jenny, or the one you're at, Rachel. But they determined that they did not feel they had the capability to understand money service businesses well enough to take the risk of banking them. And so, I mean, there were a tiny handful, literally, I mean, I want to say there were like four, at the time that after a lot of thought and discussion, this decision was made, and it was there was a glide path created for these clients and that kind of thing. But it was more about, we don't have the resources to assess and monitor risk and activity at our size to know whether that was part of the risk. The business was more risk complex, if you will, than we were capable of managing. So we had two more topics, and we have 9 minutes. So we're gonna do the quick flyby here. But another one that I think is clearly on everybody's radar is AI tools, both in a compliance program and then on the other side, the threats that AI tools being used by the bad guys have in terms of heightening our risk of effectively detecting and where possible interdicting. So, Rachel, you want to take a crack at that one?
Yeah, sure. So, one of the goals of the AML Act of 2020 was to modernize the BSA, right, and to encourage innovation and use of technology in this space, which I know, being in the private sector, we were happy to see that, being emphasized. Obviously, as you mentioned, as the bad guys continue to evolve and they have access to these types of tools, right? We just saw that, I know FinCEN's put out an advisory on generative AI. I think FBI had a statement too recently. So as they kind of continue to evolve, we obviously want to continuously improve our program and find out ways and figure out the ways, to be better, to make our monitoring and screening models better and smarter and faster and automate all our manual processes and do all of that. And so obviously AI and machine learning, it can they have a lot of benefits to it, right? It can improve the accuracy of your models. It can reduce operating costs sometimes. So that's why a lot of banks are going into that space. I think, in terms of what we talked before about third parties, I know we focused that in banking as a service and, payment providers and that sort of thing. But obviously, these are a lot of the times banks are relying on vendors to provide these tools versus to build them in-house themselves. So those same third party management, risk management principles, those still apply here when you're looking to leverage or utilize those tools. So make sure that your third party framework includes kind of looking at and doing your due diligence on your vendor and making sure that their strategy aligns with your strategy and that you have a strategy in terms of how you plan on utilizing these kinds of tools and introducing this kind of technology into your core processes to make them better. I think it's also important, besides, testing and doing all of that stuff that we've already talked about, it's also to bring in your audit partners, as you mentioned before, Elliot, but also bring in your regulator, your exam team in when you plan on introducing this type of technology. Bring them along for the ride. Make sure that they understand what you're doing, what the benefits are, what kind of due diligence you did before introducing it, into your program, because I find that as you mentioned, you don't want a surprise auditor, you don't want a surprise examiner either. That's a bad sign if your examiner is surprised by something. So make sure you bring them along for the ride and kind of involve them really early in the process so they can kind of go along for the journey with you and ask questions, and kind of help you do that in a seamless way.
Jenny, how are you guys approaching the use of AI tools?
I think that there's a lot of efficiencies to be gained in terms of like kind of performing some of the rudimentary tasks that all of us are used to doing for, DDRs, AML investigations, fraud. So being able to lean on some of those automated tools to compile and do some of that heavy lifting, but still utilize your human experts to review and collate and deduce what is the actual story here. I think is a really nice balance, and something that I think a lot of places can move towards without, upsetting the apple cart entirely.
Terry, anything from your clients? You're on mute again.
I actually have clients that are very interested in AI for all aspects of the program, including taking first cuts at writing policies and procedures, which it can do.
And they're very generic when they do it.
Right. I mean, AI can be an incredibly useful tool. One of the areas I've seen it I've seen implemented is for weeding through false positives, for example, and in sanctions screening. Um, and it has been a useful tool, but I think was to Rachel's point, bring your regulators along so that they understand it, because it's as new for them, if not newer for them, than it is for us. Test it, as we said, do a model validation, make sure it's working, and before you actually deploy it into your systems. It's going to be incredibly useful. There's absolutely no reason why we can't make things like transaction monitoring and sanction screening more efficient than it currently is, because it's not. But it's something that needs to be looked at and tested very carefully.
So, Jenny, we're coming to the end of our time, but I know we wanted to talk briefly about trends in fraud. You mentioned it earlier, and we've certainly seen an explosion in the amount of fraud, and we're seeing more and more information coming out from the various regulators, not just law enforcement, but the bank regulators as well. What do you see as the key trends related to fraud?
Yeah, I mean, I could talk about this one for an hour, but I'll try to keep it short.
We actually did an entire webinar in October.
Perfect. Then I'll try to just state some of the most unique takeaways that maybe aren't typically mentioned. One, I think just broadly, the heartbreak of the situation, which is that so much of this fraud is being perpetrated by people who are victims of modern day slavery in South Asian countries. I'm surprised that there hasn't been, I think, more media coverage of that. And I hope that our international community can band together and start attacking the root cause of the problem, which is that. But beyond that, I mean, the schemes themselves are becoming so darn good. My dad was recently a victim of a BEC scam where the fraudster had gained access to one of his vendor's emails, read back on all of their prior conversations, and then wrote my dad an email referencing all of the prior projects that they had been working on. And then stating, oh, and by the way, I've had a change with my bank, and when my dad showed it to me, I actually thought that it wasn't fraud. But then it came to be fraud. And I thought, man, this is getting so good. And the one solace that we have in all of this is that I think that the payment mechanisms are still somewhat simplistic. So a lot of the times we're seeing folks being told to wire funds to an account in the name of, this cabinetry maker in my dad's case. But it turns out that the account on record is not in the name of that cabinetry maker. So those are simple ways for us to be detecting fraud that is taking place, regardless of the fact that the methods of execution on the fraudster's standpoint have become so incredibly sophisticated. So just not losing sight of that, that things can get really complex in terms of how they're targeting victims, but the actual mechanisms, we still have within our control the ability to identify and stop the fraud.
Well, I want to thank our experts for sharing their insights. Before the end of the year, a recording of today's conversation will be posted to the AML RightSource website. Our January webinar is on human trafficking issues for 2025, challenges, strategies, and resources. It'll be live streamed January 23rd, 1 p.m. Eastern Time, and you can register for this program on our website. And when you visit our website, you can find recordings of past webinars, podcasts, and other resources. All of us at AML RightSource wish all of you a joyful and safe holiday season, and thank you for attending today's webinar.
Thanks, Elliot.
Thank you.